$66.8 billion merger risk. AI power race strategy hits a wall. Secure your utility strategy and strengthen power growth amid the $66.8 billion Dominion Energy and NextEra merger risks. You should see Dominion's 53.8 gigawatts data center backlog as a capital allocation test, not guaranteed demand, especially alongside its proposed $66.8 billion NextEra combination today. Dominion's Q2 2026 adjusted EPS reached 79 cents versus 68 cents consensus, but operating expenses jumped from $2.71 billion to $4.15 billion, exposing costly growth pressures. Virginia data center demand moved beyond 50 gigawatts, while contracted capacity reached nearly 51 gigawatts by March, up 2.5 gigawatts from December, showing extraordinary AI concentration risk. You cannot equate 53.8 gigawatts contracted with immediate consumption because interconnection, transmission, financing, construction, customer commitments, and regulatory approvals can materially alter energization timelines. PJM's Dominion Zone recorded 23,905 megawatts summer peak and 25,413 megawatts winter peak, making 53.8 gigawatts contracted capacity more than 2.1 times summer and 2.0 times winter. Dominion added 5.3 gigawatts contracted capacity between December 2025 and July 2026, while Virginia adjusted operating earnings rose 22% to $670 million, highlighting opportunity alongside pressure. Revenue increased from $3.81 billion to $4.48 billion, a $670 million gain, yet expenses rose approximately $1.44 billion, proving demand growth carries substantial infrastructure economics and execution risk. PJM power prices surged from $28.92 per megawatt day in 2024 to 25 to $269.92 in 2025 to 26 and $329.17 in 2026 to 27, making reliability materially more expensive for customers. The Dominion Zone previously cleared at $444.26 per megawatt day, while PJM secured 134,311 megawatts UCAP with only 139 megawatts above requirements, revealing an extremely thin reliability buffer. PJM forecast peak load increased more than 5,400 megawatts year over year, while Dominion Zone summer demand is projected for 5.4% annual growth, intensifying supply constraints. L-Impact Solutions argues Dominion needs conversion discipline. Distinguish energized, construction-ready, financially committed, signed, conditional, and early-stage capacity, including 25,000 megawatts scheduled and 75,000 megawatts pipeline opportunities. You should demand milestone-based capital deployment, where a 1 gigawatt hyperscale project earns progressively more infrastructure commitment only after land, financing, permits, procurement, and delivery certainty improve. Large load customers should fund more incremental infrastructure when they create those costs, while Dominion applies cost per MW metrics covering transmission, distribution, generation, reserves, contributions, and recovery before approvals. The proposed merger could create a regulated utility serving approximately 10 million customer accounts, owning 110 gigawatts generation, with more than 80% regulated operations and 11% annual regulatory capital growth. NextEra and Dominion expect the $66.8 billion all-stock transaction to close during the second half of 2027, subject to shareholder and regulatory approvals across multiple states. Virginia Governor Abigail Spanberger announced intervention on August 6, seeking affordability, jobs, and clean energy commitments, while companies proposed $2.25 billion in customer bill credits. Dominion should stress test 10%, 20%, and 30% delays, cancellations, or load reductions, measuring impacts on capital expenditure, cash flow, rate-based growth, financing needs, and earnings. PJM's summer peak growth forecast fell from 6.3% in 2025 to 5.4% in 2026, proving your infrastructure decisions need scenarios, while 2,669 megawatts of new generation remains limited. L-Impact Solutions recommends tracking 8 quarterly indicators: contracted gigawatt, energized gigawatt, conversion period, capital per energized megawatt, customer-funded percentage, recovery percentage, reliability, and incremental customer rate impact. The strategic winner will not own the biggest backlog. It will convert demand into reliable, financeable, rate-recoverable assets while controlling liquidity, affordability, reliability, regulatory risk, and construction costs. Can 53.8 gigawatts of AI demand become profit, or a grid trap? Comment your answer below. For more analyses, visit our consultancy website. Link in description below. Thank you.